Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of Linc Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Naveen Agarwal, Head Institutional Equities at SKP Securities Limited. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. It's my pleasure to welcome you to this earnings conference call on behalf of Linc Limited and SKP Securities. We have with us Mr. Deepak Jalan, Managing Director, Mr. N.K. Dujari, Director of Finance, and Sanjeev Sancheti, Utis Advisors LLP, their IR partners. We'll have the opening remarks from Mr. Deepak Jalan, and Mr. Dujari will feed in with the financial overview, followed by a Q&A session. Thank you, and over to you, Mr. Jalan.
Thank you, Naveen. Good afternoon and very warm welcome to Linc Limited's Q1 FY23 earnings conference call. This is Deepak Jalan, Managing Director of Linc Limited. I will take you through the business and operational highlights of the quarter gone by, while our CFO, Mr. Dujari, will share the financial metrics. During the quarter, the company delivered a strong top-line growth. Our operating revenue for Q1 grew by over 77% as against the same quarter of the previous year, clocking an operating income of around rupees 98 crores. However, the first quarter, being traditionally a weaker quarter for the industry, revenue on quarter-on-quarter basis was lower by 11.4%. With Pentonic sales going strong and with plans of introducing new products, we expect strong top-line growth in the coming quarters as well. In the popular segment of writing instruments, more specifically the pen segment, the company continues to have a strong presence with market share of about 8%. Company's focus on rupees 10 plus segment since the launch of Pentonic brand has helped the company grow at a faster pace. One of the USPs of the product, its perceived value due to its unique design, has gone a long way in establishing Pentonic as one of the strongest brands in its segment. In little over 3 years, Pentonic now contributes over 30% of company's core revenue as against only 7% in FY19. Due to higher GPM of over 40% for Pentonic, the company's average GPM, which was below 22% in FY18, has steadily increased to more than 25% in Q1 FY23. The company has been witnessing sharp increase in input costs during the last few quarters due to continuous rise in crude and polymer prices. Q1 also saw all-round cost increase. However, the company was able to pass on the cost increase by increasing the selling prices with effect from April. Consequently, gross margin improved from 22.9% in Q4 FY22 to 25.4% in Q1 FY23. Operating EBITDA margin increased both year-on-year basis and quarter-on-quarter basis. I'm glad to share that the input costs have started to come off and prices of key inputs are expected to remain benign in the coming quarters, which should help us in further improving our margins and profitability going forward. Linc 2.0, with the 5-pronged strategy, that we have embarked upon, as was discussed in our previous call, we believe the company will not only grow rapidly over the next few years, but will also be able to expand its margins with judicious business mix and economies of scale. Let me touch upon the 5-pronged strategy briefly, which is adopted by the company. Number 1, increased touch points. India has over 10 million non-stationary outlets, likes of kiranas, medical stores, Pan Plus stores, etc. And from nowhere in FY20, the company has reached to almost 1.25 lakh such outlets directly, thus taking its total touch points to over 2.3 lakh outlets, including the stationary outlets. The company expects to expand its overall reach to more than 5 lakh outlets by FY25. Number 2, focus on higher margin products. As informed earlier also, our focus is more on the higher value and higher margin products. And we will soon be launching pens at rupees 20 and at rupees 40 under the Pentonic portfolio. Number 3, inroads into stationery products. Companies foray into the full range of stationery products through exclusive tie-up with the Delhi is progressing well, and we expect to generate a minimum of rupees 100 crores of revenue in 3 to 4 years' time. Fourth point is stepping up of the existing capacity. To meet the targeted demand, we are planning to increase our manufacturing capacity at Gujarat by putting up additional manufacturing facility adjacent to our existing factory. The fifth point, ESG. On ESG front, company is taking the following initiatives: substituting plastic wrappers with bulk packing in paper boxes. This initiative saved about 60 tons of plastic in FY22. We employ more than 1,200 female workers in our manufacturing facilities. We also employ and provide training to a small number of specially abled workforce. We support several NGOs who provide education to the less privileged sections of the society. The company is actively working on projects like recycling of used pens. Consumers are encouraged to change the refill rather than buying a new pen under its Refill More campaign. These efforts will go a long way in contributing towards reducing carbon footprint of our planet. Now, I would like to hand over the call to Mr. Dujari to provide updates on financial numbers. Thank you.
Thank you, Mr. Jalan. Good afternoon, ladies and gentlemen. Many thanks for joining the Q1 FY23 Linc Limited earnings con call. I will give a brief overview of the financial numbers for the quarter before we open for Q&A. During Q1 FY23, company's operating revenue grew by 78% from 55 crore in Q1 FY22 to 98 crores. However, as explained earlier, operating income fell by 11% quarter on quarter, as the first quarter is traditionally weaker for the writing instrument industry. Operating EBITDA in Q1 FY23 increased by over 480% to 8 crore versus 1.4 crore with an operating EBITDA margin of 8.2%. As already explained earlier, operating EBITDA and EBITDA margin increased in spite of all around increase in cost, as the company was able to increase the selling price of its legacy products under Linc brand from April 22. Higher input cost has kept the margins under pressure in FY22. However, input prices have started softening from second quarter, and we expect prices to stabilize at lower levels in these ensuing quarters. These, along with increase in selling prices, augur well for the company's margin and profit. Q1 FY23 profit before tax stood at 5.9 crores, up from loss of rupees 1.6 crore in the same quarter of the previous year. quarter one FY23 EPS stood at 2.95 versus negative 0.82 in the same period last year. Company continues to use its free cash flow judiciously, and in the process has been able to reduce its net debt significantly in the last 4 years. In fact, the net debt reduced from over 65 crore in FY18 to less than zero as on 30th June 22. The company is extremely focused in using its resources judiciously and has embarked upon a modular expansion plan in Gujarat. While the basic infrastructure is being created to double its capacity to 20 lakh pens per day, some of the critical equipment and machinery will be added in modular fashion in sync with the demand needs. With the total project cost expected to be 50 crores, the first phase of the expansion, which will increase the capacity by 5 lakh pens per day, will cost only 35 crores and will be operational by quarter 4 FY24. The expansion will be largely funded by internal accrual and a small loan of not more than rupees 15 crores. On the back of expanded capacity and with customer demand expected to be buoyant, the company is well set to achieve the top line of over 600 crore by FY25 with CAGR of over 20%. During this period, share of Pentonic revenue is expected to grow to over 32%, while Delhi is expected to contribute around 15%. With pandemic behind us, cost of raw materials starting to soften, strong growth prospects, increased penetration through Kirana network, and focus on Pentonic, we should be able to achieve annual operating EBITDA margin of over 12% by FY25. With low cost modular expansion and judicious use of debt, we also expect ROE to cross 18% by FY25. We continue to remain focused on our long-term goals of sustainable growth, profitability, and strong deleveraged balance sheet. With this, I leave the floor open for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Zaki Nasser, an individual investor. Please go ahead.
Sir, first of all, Deepakji, I would like to congratulate you and your team on the fantastic quarter numbers given by sir. My first question is, sir, broadly, according to our investor presentation, we have 3 broad verticals. One is our own pens, one is the Delhi portfolio, and another is your tie-up with Uniball. Sir, would you slightly give a small explanation on how you see these 3 panning out in the future, sir, on your journey towards 600 crores? The second question would be, sir, broadly, there's a lot of talk about reduction of pens, usage of pens due to computerization. Your thoughts on this aspect of argument, sir? Thank you.
Yes, Mr. Jaki. Coming to the first question, of our revenue target of 600 crores by FY25. We estimate that the contribution of Delhi and Uni together should contribute about 25% of our total revenue. So 75% we are expecting from Linc and Pentonic, both by way of exports and the local market. And so about 150 crores from Uniball and Delhi we are expecting. Coming to the next question of future of pen, I would say. So I'm actually getting this question for last more than 10 to 15 years that what is the future of pen. But as you would know that even though there has been a lot of digitalization, the pen is still needed. And I have, even observed in the developed countries like the US and, even Europe, the pens are still, so there is actually no degrowth even in those markets. So it's, of course, it is flat, but there is no negative growth. While there has been, growth, rather close to double-digit growth in the developing countries, like, say, for example, Africa, or even in our own country, we have a decent, single-digit growth, even though we have a single-digit growth in India. So, but it's a decent single-digit growth. So I don't foresee any challenge or any threat to the future of pen, at least for many years.
Thank you, sir, and best wishes for the balance of the year. So thank you.
Thank you, Mr. Nasir.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Shubhankar Oja from SKS Capital. Please go ahead.
Hi, thanks for this opportunity. So 2 questions. One, can you give me the capex number once again, and what capacity you are adding in your Gujarat facility? That's one. And secondly, can you quantify the price hike that you have taken in order to pass on the cost pressure?
Okay, so Mr. Dujari will share the capex details. And so far the price increase, we've been able to increase price by on average about 5% on our products. So yeah, when I say average means on some products we've been able to increase prices by even 10%, but on some products the price increase has been even lower than 5%, but on average, it's been about 5%. And coming to the capex,
the total capex we are expecting for the new facility is around 50 crore. So we will split that in 2 phases. In first phase, we'll spend 35 crore for the basic infrastructure and the machines, and in the second phase, we'll spend around 15 crore on the machines. So in the first phase, we will expand the capacity by 5 lakh per day, and in the second phase again, we'll expand the capacity by another 5 lakh per day. So this is beyond our normal capex. This is only the capex for the new facility.
And you said this will be operational FY24.
Yeah, FY24 quarter 4 we should be operational. First phase should be operational by quarter 4 FY24.
All right. And by when do you plan to launch this new product of rupees 20 and rupees 40 Pentonic varieties?
So the rupee 40 pen is going to be, it's actually, we are already behind schedule. It should have been launched by now, but it should definitely be launched in next 1 month. And the 20 rupee product we intend to launch latest by 4th quarter, maybe even in 3rd quarter, but latest by 4th quarter.
Do you have any promotion, any advertisement budget in terms of for these 2 products or even otherwise? And can you quantify how much do you plan to spend?
Yeah. So generally, we have a budget of about 3% of our revenues towards advertising spend, which we, so whenever there is a new launch, the majority of the budget is, inclined towards a new launch. So this is how generally we do our advertisement spend.
All right. Thank you so much, sir, and good luck for the coming futures.
Thank you, Mr. Ojai. Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question at this time. Anyone who would like to ask a question, you may press star and 1. A reminder to all the participants, if you wish to ask a question, please press star and 1. The next question is a follow-up from the line of Shubhankar Oja from SKS Capital. Please go ahead.
Yeah. Thanks. Thanks again. So this daily, you are saying expect 100 crores of revenue. Can you give some numbers or in terms of some color, what figure you are doing right now, and how do you plan to ramp it up?
In the last quarter, I'm Dujari here. In the last quarter gone by, we have done a figure of around 5 crores from Delhi brand.
5 crores.
Yeah, it's just 5 crores in the first quarter. So this year we are expecting anything between 30 to 40 crores, and which will be actually a handsome growth over last year. And as we also estimate that by FY25 we should touch 75 crores. And then the next step would be reaching 100 crores in the following year. So that's the kind of a journey or trajectory we intend to take.
All right. Thank you again, sir.
Yeah.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Anyone who would like to ask a question, you may press star followed by 1.
Friends, this is Naveen Agarwal from SKP. I believe the presentation shared by the management and the opening remarks by Deepak ji have been detailed enough. So in case there are any follow-up questions which don't come to your mind right now, request you to share them with either Nikhil or myself. Our coordinates are mentioned on the invite. We'll take them up with the management and get back to you. So since there are no further questions, I'd like to hand over the conference to Mr. Sanjeev Sancheti for closing remarks. Sanjeev, over to you.
Yeah, thank you. Thank you, Naveen. Thank you, everybody, for joining this call. If you have any more questions, please do reach out to Mr. Naveen or to Mr. Dujari. The number of Mr. Dujari is also there on the investor presentation. Please feel free to ask any questions. We're happy to address them. Thanks a lot and have a great week ahead. Thank you.
Thank you very much. On behalf of SKP Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you and have a nice day.